Okay, so a very good morning. It is Wednesday the 7th of March. Hope everyone is well. I thought I would start with this image. I think the look on Gary Cohn's face in this photograph, I think, really sums up probably the discussions that were taking place last night before the eventual chief economic advisor to the president and the administration in the White House handed in his resignation. I've read some source reports. Some pretty heated conversations apparently took place just before the resignation, where Trump was demanding that Cohn back him on the trade tariffs, and Gary Cohn essentially said, "Enough's enough, I resign." So that's the big story of the morning. That's what I'll focus on, and we'll have a look at a couple of the headlines first, and then I'll kind of translate that over to the charts and how it's reacted, and then what my thoughts are kind of going forward on the issue. And then, as per usual, I'll hand you over to Sam. So this is the headline: Gary Cohn to resign as Trump advisor after dispute over the tariffs. A free trade proponent has been fighting the president's plan and essentially has lost out. I mean, one of the main things here, and this was the market's reaction, is, why has the market reacted to just one individual leaving? And what you've got to understand, this is more for the kind of newer people to the financial markets and how markets react to news events, is that markets are built on confidence, and confidence is key. Now, do people have confidence in Trump? Well, this could be questionable to some degree, but when they look at his administration, there are some people who are seen by market participants as more credible than others. And Gary Cohn is probably seen as the most credible. Very much a commercially minded guy, former Goldman Sachs, a person which tends to be, for the sake of a better description, a little bit more even-handed and sensible in his policy thinking in order to manage not just the political situation but the economic situation as well. And so Cohn stepping away has people worried about actually what we were talking about this time yesterday, was how much of what Trump is doing is political posturing in terms of him delivering America First policy in order to kind of cultivate and keep the sentiment running high and the confidence that got him into the White House in the first place. And obviously this comes several months, and we'll get the run into the midterms at the end of the year. And the market seemed pretty comfortable to reverse the move. So if we have a look, I mean, this chart I'm showing with you at the moment, this is when the Trump tariff plan announcement came out at the end of last week. We had that big collapse in what we're looking at here is the S&P 500. And then pretty much as we've come in on Monday, we've recovered the entire move and then held on to that recovery yesterday. Only then, though, Cohn's resignation has brought about the renewed thinking that, wow, actually, were we a little quick to think that we've heard from the various politicians on Capitol Hill? Most are very against this aggressiveness of the tactics of this 25% tariff on steel and 10% on aluminium, mainly because of the retaliation effect on large market players like Europe, for example, and what that might have then as a detriment to the US economy. But Cohn stepping aside almost makes it easier for Trump to really push through and really get behind this policy. Whether or not he can get those other politicians within the Republican Party and the two chambers of Congress to agree is another matter. But at least in the short term, this has been seen as quite a net negative. And how does the market and how has it reacted in this situation? As you can quite clearly see, equities weaken. But not only does the equity market weaken, the dollar also weakens, because it would be to the detriment if this trade war situation were to escalate for all parties involved. So it isn't just about Cohn though, because also, Trump, he wouldn't stop there. He also threw in the mix late last night, the US is considering broad curbs on Chinese imports and takeovers. Let's not forget on who Trump is trying to target here. The ultimate kind of competitor, if you're talking about global trade, in the eyes of currency manipulating for the US administration, has always been China. The only problem is this tariff on steel and aluminium, as we've been talking about since the last week, is more impactful for the likes of the NAFTA agreement in Canada and Mexico, their trade partners, which are extremely dependent on selling those goods to the US. But Trump's escalated it again. And now what he's talking about is the administration considering clamping down on Chinese investments in the US and imposing tariffs on a broad range of its imports to punish Beijing for alleged theft of intellectual property, according to people familiar with the matter. So this isn't particularly new in terms of a stance from the US, but obviously timing is key. And at the moment, this coming as a dual effect with Cohn's resignation, what has that created? Well, looking at the charts this morning, in this center right chart here, I mean, I'll leave it for the technical perspective for Sam to talk about more, but you can see this double top quite clearly forming here on that gap lower that we had at the reopening of futures. But sharp gap lower. Dollar was weaker overnight, but do bear in mind it has steadied since, and as Europe's come in, the dollar index has actually closed the gap to levels which we were trading at yesterday. So although euro dollar is pretty flat, and you can see that's the slight gap up we had this morning, and then we've kind of moved higher in Asian trade, but a little bit of profit taking perhaps on that move. Cable a little lower. There is a little bit of Brexit commentary to be aware of, and we are sub pivot, but the weaker dollar and this kind of general kind of mild flight to quality move, meaning that gold a little bit elevated. So looking at gold here, holding on to the bulk of the gains that we're seeing yesterday. We've come off a little bit, we're down about $1, but again, in the context, since really the 1st of March, when we were trading down at a kind of a 13.10 type level, we're now up at, maxing out at about a 13.40 price level. So pretty decent move over the last couple of days since this trade talk has heated up. Elsewhere, obviously T-notes are seen a little higher with this kind of flight to quality move. You can see at the reopening of trade when equities really gapped down, T-notes gapped up and rallied. We got through our one momentarily before then pairing that move back, and although we're only up about 4 ticks, I would be keeping an eye on any potential gap fill. That pivot level, the 120 handle, would be a pretty logical target, given that was where the market closed last night in the Treasury in T-note futures. So that's the US situation. Other news that we've had is I did see quite an interesting research report, and I did send this out to you guys from the chaps at Pictet Asset Management. They were looking at what their thoughts are for the Italian elections going forward. And obviously we've talked about the fact that Italy's in kind of this period of trying to negotiate, and what would the difference in, or what would the coalition look like in terms of its partners involved. And this table just looks at the number of days to form a government. This goes back, actually I think it goes back more than 2 decades, this analysis. But on average, what it's saying is that post-election, it takes approximately a gap of 51 days before then a kind of an agreement is found. So to give you a bit of a reference point, is a bit varied though. If you actually look in terms of the more recent passage of time. But we have had news on this last night, and it's everyone's favourite, Silvio Berlusconi is ready to give the leader of the Eurosceptic partner, the League, Matteo Salvini, his support in attempts to form a government, according to the former Italian Prime Minister. So this was an interview in the local Italian press. But Berlusconi ready to support the League leaders' bid to form a government. So why has this happened? Well, one of the things was that Berlusconi's Forza Italia party was unexpectedly surpassed by the far-right League. So it has changed a little bit what people were thinking going into this election, given the result, as their centre-right alliance together won about 37% of the vote, which is essentially shy of that 40% threshold for the majority. So Berlusconi, in his own words, has said, in full respect of our arrangements, I will now loyally support attempts by Salvini to create a government. So has been a little bit of movement here. Has it been reflected in market prices? No, because then this is when you are interpreting the news. Italy, just given the gravity of the Cohn situation and the Chinese comment that they've made, well, the US administration about China, the Italian one is taking a bit of a back seat. for the time being, but definitely is something I would be continuing to monitor. On the UK front, I did say there was a little bit of Brexit news, so here it is. UK's trade with 70 nations is in danger of falling off a cliff edge if Theresa May's government doesn't step up efforts to replicate the European Union's commerce agreements. This is citing a panel of lawmakers. Now, two things I would say when you read this type of article. For one, Bloomberg are outright pro-Remain. So do be a little bit mindful of where you read the information. It's kind of like reading, let's say, the Daily Mail comparative to the Observer. Both definitely aligned with a political view, and so you have to take it with a bit of a pinch of salt when you're reading the type of content. I'd say Bloomberg definitely fits much more of the view of being pro-Europe in that sense. But the other thing, this is a panel of lawmakers, and so we've always known that the legal complexity surrounding this framework agreement and this transitional deal, highly complex and highly destabilizing if not done correctly and in a timely fashion. So I don't think this in itself is particularly market moving or new, but what it does do is, and what we've been talking about for a while, is on the key timeline for Brexit events that are coming up. This March 22nd, 23rd meeting just keeps getting more and more and more important. You know, the lawmakers are saying it, the financial services community, which is pivotal to our UK economy, is saying it in terms of them needing time to execute their contingency plans. The politicians, in terms of this divide in the Conservative Party and the fate and leadership of Theresa May, it's almost like it's getting more and more important, this event. So again, I just point out the fact that you're going to hear the kind of frequency of headlines pertaining to the Brexit situation and this negotiation and the stance ahead of that more and more. So leaks and rumours and things like that, I would say, will start to intensify in the next 2 weeks. I am sure of it. But again, a lot is riding on this meeting, and so in a couple of weeks' time, we'll be expecting, it's kind of a bit of a make or break. She comes out with a deal, secures a transitional agreement. Well, I'm expecting this pound to rally aggressively under those circumstances, particularly in the narrative of a weaker dollar with heightened trade war risk. There's definitely meaningful upside that could be seen. On the flip side, though, if it doesn't go well and she comes out of it without making any headway and we're in the same situation, well then this threat of a vote of no confidence in May's government could then be the first domino to fall in the Tory government, which would be incredibly interesting, and the opposite effect in that sense. Political uncertainty and pound weakness, so a lot to play for. Finally, just to wrap things up, you had the API crude oil inventories last night, so I'll go over this again closer towards the time of the DOE report, but this is what we're looking at. You had a crude build of 5.66 million, higher than expected, so bearish outcome on the crude figure alone, but Cushing was a draw of 790,000. Gasoline was a draw of 4.536 million, the biggest drawdown in gasoline since October of 2017. So you had a complete reverse situation. Bearish on the crude with a big build, but bullish on the gasoline. So what did this look like in prices? Well, this is a chart here mapping on the bottom. This is WTI crude dropping, the futures last night, and this is gasoline popping higher. So you've got the two kind of converging on the fact that there was counterintuitive data for each report. Having a look at the crude market this morning, it has traded a little heavy, and we've just come down to have a brief test here of that previous low, which came, well, if I just highlight and identify when the data came out from last night. So this was the move when the APIs were released. We reopened in trade, gapped a little lower. Probably as well, a little bit of a net reason of this is not just singly the fact that we had a big build. Don't forget, if this trade talk idea is that there's more validity behind it with Gary Cohn removed, then obviously this is destabilizing for all economies involved, which means slower economic growth equaling lower demand. and impacting that side of the supply and demand equation for crude oil. And so maybe a little bit of weakness here that you saw, this kind of reopening of trade at 11, the first 2 hours of selling when we hit that initial or original low point would have come when the equity markets were under some pressure. And so again, it's kind of a unique situation where you've got dollar selling, equity US indices selling, and oil selling, because it's kind of changing the short-term view about the economic climate globally, not just the US, and so consequently impacting demand. Quick look at the calendar. A few things to be aware of. New homeowner Sam will be happy to know that Halifax house prices have gone up higher than expected this morning. So buying the dip in that sense. But looking elsewhere, ADP national employment, that's going to be one of the main features coming out later on this afternoon. So if I switch over to the calendar, this is the kind of major precursor to the Bureau of Labour Statistics non-farm payrolls, which we'll get on Friday. It's probably the most closely correlated report that we see in terms of a relative same sample of data, but this obviously for the private sector. So this is expected at 195,000. What does that look like in the case of recent history? 195,000 puts us really bang right in the middle of the average number of the last 12 months. If we were looking at the high and low, 172 at the low, 290 at the high, 172 would be no surprise or shock at all. 292, let's put it out on a 5-year, 292 actually puts us back up at really 2014 highs. So that would be a pretty punchy number on the upside. Does that materially make a difference though to what the market is expecting to non-farms and the overall Fed policy agenda? I don't think so. Because even if you had job creation growth of 290,000, that's not what market participants are focused on. What we're concerned about is last non-farm payrolls, the average hourly earnings year on year jumped to 2.9%, much higher than expected. And that was the catalyst for then the subsequent sell-off that we saw on February 5th, when the equity market saw its biggest downward move in a long period of time. People are going to be absolutely focused on that average hourly earnings number, not the headline job creation, which is expected to be relatively steady. So I'd keep an eye on ADP for sure. Wouldn't keep an open position over the data release, but I don't think it's going to be potentially a real big shock for the market in either direction. Other things to be aware of: US trade balance is coming out at the same time, or actually 1:30 ADP is 1:15. Then you've got the Bank of Canada interest rate decision. This is always volatility for the currency and the loonie. Even though we're not expecting interest rate change, it's going to be the language in their accompanying monetary policy report that will be key. And then you've got the oil inventories, which will go over the APIs again closer towards the time of release, as that always adds a little bit of short-term market movement. Speaker-wise, you have had Fed's Brainard speak overnight. Now, as you've got noted here, typically she is a voter, as a dove. But check out the comments that she said last night, overnight, because her comments have already come out. She said, US economy's headwinds are shifting to tailwinds. Now, we've got some new trainees that have just started this week, and I was trying to start from the bottom up in terms of monetary policy language, and this understanding that simple word changes can be absolutely dramatic for how the markets perceive the future direction of monetary policy and therefore the pricing of assets in the immediate term. And this is a classic point. Just a simple change of the word headwinds to tailwinds from a traditionally a dovish-leaning member is a complete elevation in the fact that she is totally more optimistic about forward-looking economic conditions and therefore supports the view of a tightening of interest rate policy. If the most dovish person is starting to sound quite hawkish in a sense that we need to get this rate rising process underway, then this definitely is quite a strong shift towards, as the market is increasingly starting to expect, that 3 might become 4 rate hikes. The interesting thing will be, for a lot of central banks, and particularly the ECB tomorrow, how much has this trade war situation instigated by Trump influencing their thinking right here, right now. And actually, that might be one of the reasons why the ECB might put off any real signals about policy tightening in the near term. But quite an interesting comment here from Brainard last night. Going back to the other speakers, you've got Dudley, who's also spoken last night, but nothing quite as significant as Brainard. Looking at the session ahead, Fed's Bostic, a voter speaking on the economic outlook, so this will need to be monitored, particularly, as I said, with this trade focus at the moment. You've also got Dudley speaking again later on in the afternoon, so quite a few things to keep your eye on. All right, that's it from me. Going to hand you over to Sam. He's going to look at some of the charts, but have a good day, everyone.
Good morning, guys. Just going to start off looking at US equities, which of course, as Ant mentioned, and you can see in your own charts, gap lower quite dramatically there. The highs of the day, the double top, as he mentioned, going to be the key level to the upside for now. If we break through there, we'll be having a look at the previous lows, which of course act as resistance to the upside. You've got obviously S1 today, basically being your mathematical resistance level as well. In terms of where we could come back down to, obviously you've got the S2 here acting as support, a few previous highs of the day. Let me just lower this time frame down, and you can start to perhaps get a bit of a picture here of this little range that we're going to be in for the next few minutes or so. But definitely keeping an eye on those double tops. And it's going to be the same sort of picture going across the board over to the Dow Jones, albeit slightly less higher on the recent top that we had. Nasdaq quite a lot more similar to that S&P. I would be, thinking about the S2s here as potential areas of support, but wouldn't perhaps be looking to get in this morning. As you can see, if I just let me just rectangle those areas up on the S2. We've spent a bit of time, early on going through, then to the up, and it's got slightly messy. So perhaps better for this this kind of trade idea, if you are looking for a place to go long, to really just prefer a break of those highs and then sort of targeting the previous lows of yesterday. Here in the Nasdaq, you can see yesterday's low and today's S1 matching up quite well. In terms of levels to the downside, let's just go back to the S&P. If we were to continue the move lower and that high just to firmly stay as a double top, you get a break through this key level that we made this morning, and then finally broke through, could offer a bit of a move to the downside. And I would still have the trend line going on those lows there, target area to the downside, or for anyone brave enough to look to go long from around there as well. And you could probably get that marked up as well, going back from the low of the second there for the S&P. And it looked very similar for the Dow Jones as well. We'll come obviously onto oil later on in the day, but you could just see I was low this time from down about 5 minutes ago. Just pushed to a new low, albeit by a couple of ticks, nothing too extravagant there. Highs of the day pretty much in line, so I'm just going to get this rectangle here again. You can see we're sort of stuck within this range for now. Probably best to again wait until the afternoon, but for those that perhaps are looking for an area to continue this move to the downside, you've got quite an interesting area at $62. You can see we'll support once, twice, 3 times on the 15-minute before breaking through, and we haven't really come back to test that yet. So $62 and the previous lows of the day, lows of the morning, I should say, sorry. An area to be aware of. If we were to push down before the deal, we obviously don't perhaps want to have profit expectations that are too big. The next sort of market-related level of significance I would have around the S2, which did act as brief resistance on the Monday before as well. So keep an eye out for oil, but perhaps better to be looking at that in a bit more detail come 3:30 this afternoon. Pound just breaking through the pivot. Just put this on a 15-minute chart. You can see here breaking through Was also a good area of support that we found last night. So that whole area just for now breaking to the downside. You can see what was the low of the day above the pivot, then acting resistance. There's a resistance level just recently. If we are to continue to push down, levels to be aware of, you've got the yesterday Asian session high at 1 a.m. that we made 138.69 on cable to be aware of. And you can also see that's really where the move pushed on. So for futures levels there, 138.69 would be the sort of the next area of support to be aware of. If we were to get through there, that does sort of open the door to the downside. At the same time, having a quick look over at the euro, which is pretty much near that low of the day as well, stuck within this range. I would prefer really to see, you know, a break either way. And if we do break 124.08, opens the door up to the 124 handle and this area of support that we made yesterday afternoon. So for euro, I'd be preferring to see a breakdown before wanting to get involved in that around now. T-notes, which gapped higher, actually just pushing to its lower levels of the day now, and there you go, just completing that gap there on that support level. So worth keeping an eye when trading today on T-notes and equities at the same time, just to see if anything can sort of develop there from a correlation point of view. Gold very similar, in fact it gapped higher, and we've we completed that gap early on. Pivot offering a level of support for now. If just looking at this in a bit more detail, I think the level I like in gold would be around about here, the higher the 5th, and then where we really pushed on yesterday afternoon, so 13.28 for gold would be an interesting level. And you can see even previously had some decent price action around that point. So that would be the area of interest for me for gold going into the day. But you've obviously got data coming out from the US at 1:15, which could shake things up ahead of the non-farm payrolls on Friday. Let's have a quick look over at Aussie dollar and the yen. You can see we're sort of hanging around that pivot. Another example really when a level is probably over tested and best to sort of wait for a break of that range. You see here perhaps 77.96 and 78.18, really looking for a break either way to get a clear move and avoid the noise and that chop around that level. The yen here, just going to get a trend line going on those highs around there with the S1 for the day. Price getting squeezed in this morning, couple of lower highs and higher lows. We'll probably keep that on, but a significant gap to the downside as you'd expect with equities also gapping lower, but worth keeping an eye on that trend line, both to the up and the downside. And of course I think S&P, if we just go back to that, keeping an eye on the high at a similar sort of time. If we were to break through dollar yen to the upside, you'd presume that equities in the US would be near their highs. Quick look over at the DAX just to finish things up. Gapping lower as well, and always an interesting one just to be aware of. If we do push on, it could easily fill the gap quite quickly, so would not want to stand in its way if it was to get up to that high again. The level we mentioned yesterday, yesterday's high, held quite well, and you can see, let me just mark that up again, why that's important. You had the low here on the 15th and the 21st before breaking through on the 1st and finding resistance once we did that, and then yesterday as well. So still keep an eye on that level. I'm not saying we're going to get there today, but it's shown to be quite a strong level. Eurostock similar in that respect, in that we gapped lower, and yesterday's high held very well along with the previous day's support that turned resistance. Any questions, please do get them in the chat. Let me know what you're looking at as well. But if not, have a good trading day, and I'll catch you later on.